In January 2019, a company that had never made a single penny of profit was worth $47 billion. By October, that number was $8 billion. 4 years later, bankruptcy. And the man who built it and burned it walked away with $1.7 billion in his pocket. Here's the thing. This isn't a story about a bad idea. The offices were real. The desks were real. The coffee was real. 500,000 people turned up to a WeWork every single morning and actually worked there. The idea worked. It was everything around it. The valuation, the ego, the checks. That was fiction. So how does a co-working business that charges people to sit at a desk become worth more than BP? Let's go back to the beginning. Adam Neumann was born in Israel in 1979. He spent part of his childhood on a kibbutz, a communal settlement where people share meals, resources, everything. Built on the idea that community creates value that individuals can't create alone. He moves to New York in his early 20s and fails. Repeatedly. There's a women's shoe business, shoes with collapsible heels. Doesn't take off. A baby knee pad company called Crawlers. Goes nowhere. By any normal measure, he's just another immigrant entrepreneur burning through bad ideas in a city that doesn't care. Then in 2008, something clicks. He partners with an American named Miguel McKelvey, and they launch Green Desk, an eco-friendly co-working space in Brooklyn. Rent desks to startups and freelancers. $350 to $2,400 a month. Within a year, more than 100 members. They sell to their landlord, pocket the money, and use it as seed capital for something bigger. That something is WeWork. Founded 2010. First location opens April 2011, Soho, Manhattan. Here's the actual business model. Stripped of the mythology. Sign long-term leases on big office floors. Chop them into smaller units. Sublease those units to startups at a markup. Classic arbitrage. Buy low, sell high, pocket the spread. There's nothing revolutionary about it. Commercial landlords have done variations of this for decades. But here's where Neumann does something genuinely extraordinary. He doesn't sell it as real estate. He sells it as a movement. WeWork isn't an office. It's a physical social network. The company's mission, he says, is to elevate the world's consciousness. Investors aren't renting desks. They're building community. And impossibly, investors start nodding along. By 2013, WeWork has 350 startup clients. By 2014, fastest growing lessee of new office space in New York City. Valuations start climbing in a way that makes no sense if you look at the numbers, but makes perfect sense if you squint and pretend you're investing in a tech company. 1.5 billion in 2014, 5 billion in 2015, 16 billion in 2017, 20 billion in 2018. And then, Masayoshi Son walks in. Son is the founder of SoftBank, a Japanese conglomerate. He's the man who handed Jack Ma $20 million for Alibaba after a 6-minute meeting. He invests on instinct, at scale, faster than anyone else tracks. In late 2016, Son meets Adam Neumann. Their conversation reportedly lasts 12 minutes. By August 2017, a $4.4 billion investment is announced. Son will later admit, publicly, that he didn't do enough due diligence. 12 minutes. $4.4 billion. In November 2018, SoftBank invests another $3 billion. In January 2019, another $2 billion on top of that. Those 2 rounds alone push WeWork's paper valuation from $20 billion to $47 billion, a $27 billion increase manufactured almost entirely by one investor, writing progressively larger checks. The market didn't drive WeWork to $47 billion. Masayoshi Son's checkbook did. And while all of this is happening, the red flags are stacking up in ways that should be impossible to ignore. Neumann personally trademarks the word "we," then charges his own company nearly $6 million to license it back. He is literally billing WeWork for the right to use its own name. He then takes $700 million out of WeWork in loans and share sales before the company has ever attempted to go public. $700,000, personally extracted. from a business that has never made a profit. His wife, Rebecca, who holds no formal board position, reportedly fires employees based on bad vibes. Neumann dismisses entire groups of staff who have bad energy. He bans meat from all company events globally, not just from WeWork's own kitchen, but from every external catering order. Announced unilaterally. Every WeWork aircraft must be stocked with Don Julio 1942 tequila. Morning executive retreats apparently include shots. People see all of this and keep writing the checks. Because the working theory, the bet Masayoshi Son and a parade of sophisticated investors are making, is that Neumann's chaos and his genius are the same thing. That you can't separate the vision from the recklessness. That this is just what a world-changing founder looks like. That bet will ultimately cost SoftBank $11.5 billion. The reckoning arrives on August 14, 2019. That's the day WeWork files its S-1 prospectus with the Securities and Exchange Commission, the document a company submits when it's about to go public. After years of private valuations and investor hype, this is supposed to be the moment of triumph. Instead, it's the moment everything unravels. The S-1 reveals, in excruciating detail, that WeWork has been losing money on a scale that defies comprehension. In the first 6 months of 2019 alone, January through June, the company lost $900,000 total losses from 2016 to 2019 approach, $3 billion. In 2018, WeWork lost $1.9 billion on revenues of $1.82 billion. They were losing more than $1 for every dollar they made. Now, the WeWork team knows these numbers look bad, so they include in the S1 a new financial metric they've invented specifically for this document. They call it Community Adjusted EBITDA. EBITDA is a standard measure of earnings. Earnings before interest, taxes, depreciation, and amortization. It gives a cleaner picture of operational performance. WeWork's version strips out the standard items, yes, but also marketing costs, executive salaries, the deep rent discounts offered to attract startup clients, and straight-lined rent expenses. Essentially, it removes all the biggest costs of running WeWork. Using this metric, the losses largely disappear. The SEC formally questions the accounting. WeWork eventually renames the metric contribution margin. The underlying losses remain exactly the same. The financial press gets hold of the S1 within hours. Within 24 hours, the New York Times, the Wall Street Journal, and the Financial Times have all published analyses concluding the valuation is indefensible. A Harvard Business School professor publishes a paper titled "Why WeWork Won't," calculating that the company would need to capture 100% of its addressable market to justify a $47 billion price tag. Not 50%, 100%, every single potential customer. And then the IPO Roadshow begins. This is the series of meetings where Neumann personally pitches fund managers across the country. Attendees describe it as bizarre. He reportedly tells investors he plans to live forever. He talks about becoming the world's first trillionaire. Fund managers who expected a sober business presentation walk out shaking their heads. On September 17, 2019, WeWork announces it is postponing the IPO. The S1 is formally withdrawn on September 30th. The stock market never sees it. The $47 billion valuation craters to $8 billion in under 6 weeks. $39 billion of paper wealth. Gone. The investor pressure on the WeWork board is now overwhelming. On September 24, 2019, just 41 days after the S1 was filed, Adam Neumann resigns as CEO and surrenders majority voting control of WeWork. His exit package is $1.7 billion. Let that settle. He is paid $1.7 billion to leave the company he drove into the ground. SoftBank buys out his shares and takes majority control. The company, now valued at around $8 billion, receives a $9.5 billion bailout from SoftBank just to stay alive. That is an 83% collapse from peak valuation. In the months that follow, approximately 2,400 employees, roughly 1 in 5 of WeWork's global workforce, are laid off. Masayoshi Son, who staked his reputation and the entire SoftBank Vision Fund on this bet, is forced to publicly apologize to his own investors. The Vision Fund posts a loss of nearly $18 billion, one of the largest single-year investment fund losses ever recorded. SoftBank's profits collapse 99% in a single quarter. WeWork staggers forward after the bailout, but it never finds stable ground. When COVID-19 hits in 2020, it destroys what's left of the co-working model. Corporate clients abandon short-term flexible leases. WeWork is still locked into long-term commitments on hundreds of floors of empty office space. The model that was always stretched in good times is now catastrophically exposed. On November 6, 2023, WeWork files for Chapter 11 bankruptcy protection. Total debts, $18.65 billion against assets of $15.06 billion. Approximately $100 million in unpaid rent alone. The company that was once worth $47 billion cannot pay its landlords. WeWork emerges from bankruptcy on June 11, 2024, after 92% of its secured lenders agree to convert $3 billion of debt into equity. It still exists. Smaller, quieter, managing co-working spaces across the US and Canada. The logo is still on the door in some buildings, but the vision, the consciousness elevation, the physical social network, all of that is gone. Adam Neumann is fine. Having pocketed $1.7 billion on his way out the door, he does not disappear. In 2022, he founds a new company called Flow, a residential real estate business focused on rental apartment buildings in Nashville, Atlanta, and Miami. The pitch has a familiar shape, not just housing, but community. Not just apartments, but a new way of living together. Andreessen Horowitz, one of the most prestigious venture capital firms in Silicon Valley, writes him a $350 million check. The largest single investment A16Z has ever made in one company. Valuation: over $1 billion before Flow has proven the model works. In 2024, Neumann attempts to buy WeWork back out of bankruptcy. The bid is rejected. And Masayoshi Son? After losing $11.5 billion on Neumann's last venture, he reportedly tried to negotiate his own check into Flow, before Andreessen Horowitz got there first. Here's what gets lost in the wreckage. At its peak, WeWork had more than 600,000 paying customers across more than 800 locations in over 30 countries. 500,000 people showed up every morning and worked there. The spaces were real. The desks were real. The coffee was real. Measured by desks filled, it worked. Measured by dollars, it was always a fiction. The model required constant growth to mask losses that compounded with every new lease signed. The $47 billion valuation was never a number the business could support. It was a number the story could support, for as long as everyone agreed to keep believing it. And here's the pattern worth taking away, because you'll see it again. The lesson isn't that charismatic founders are dangerous. History is full of charismatic founders who built real things. The lesson is about what happens when there's enough money in one room. When the checks are large enough, everyone in that room needs the story to be true. That need becomes more powerful than the numbers, more powerful than the red flags, more powerful than a cereal box full of weed on a private jet. The question that nobody in that room ever asked loudly enough, and the one you should always ask: whose fault was it more? The man who told the lie? Or the men who paid $47 billion to believe it?